Curious about how portfolio management services really work? Want to understand how your portfolios are built, what kind of strategies are right for your financial goals, or is a PMS right fit for you? We are hosting an exclusive webinar, I Thought PMS Universe, everything you need to know. This is your chance to get a complete walkthrough on our PMS philosophy, our strategies from blue chip to multi-cap to small cap, and how we manage risk and performance over a long period of time. Whether you are exploring PMS for the first time or want to get deeper into how we work, this session is designed for you. It's online, free, and open for all. Tap the link attached below to register and get the invite. If you have been granted employee stock options recently, that's a big milestone. It's more than just a reward, it's a stake in your company's future. And yes, ESOPs can be a powerful wealth building tool if managed smartly. But here's a question most people don't ask until it's too late. How much ESOP exposure is too much? Because what starts small can quietly grow into a biggest chunk of your entire net worth or a portfolio and have a huge risk. So managing ESOPs from reward to risk is what we want to look at. Let's decode how ESOPs work, where the real risks lie, how to manage them smartly, and how to make them a strategic part of your financial plan. So what are ESOPs? An ESOP or employee stock option plan gives you the option to buy your company shares at a pre-fixed rate, offer lower than market value once you complete a certain period of employment. If your company performs well, your stock price go up, you win. You buy low and let's say sell high. Sounds simple, right? But in reality, things get tricky with vesting rules, taxation, timing, and portfolio concentration. So let's look at a story or let's look at a real world example. Meet Rohan, a mid-career professional in the tech space. Over the years, he built a 10 crore investment portfolio, but here's the catch. 5.5 crores of that was tied up in his company stock, thanks to ESOP. He had mapped his ESOP portfolio to his retirement goal. That's 54% of his entire net worth in one single stock. He was bullish, he held on to it and had conviction on the business. But then the stock fell 30%, and so did the bulk of his net worth. Panic set in. Should I sell? Should I wait? Will it recover? This wasn't a tax problem or even a timing mistake. It was a concentration risk. Where people generally go wrong, it's not on receiving ESOP. That's a great benefit. Not even in believing the company's potential or the conviction of the company. The mistake is letting them dominate your portfolio. When your job and your investments depend on your employer, you're fully exposed to one company's ups and downs. Let's look at some smarter ways to manage your risk in ESOPs. Set a cap on your ESOP exposure. Aim to keep your ESOPs within 15 to 20% of your total financial assets and your investment portfolio. It's okay to believe in your company, just don't bet everything on it. Diversify across other assets, mutual funds, PMS, fixed income, gold, real estate, and whatnot. Let ESOP be just one part of your wealth strategy, not just the entire story. Sell in tranches, or let's say, for example, don't wait for the perfect price to start trimming it. Sell it in over a phased period of time. This helps you lock in gains and reduces regret if your stock swings the other way. Understand taxation better. You pay taxes twice on ESOPs at exercise. The difference between your exercise price and the fair market value is taxed at your slab rate. At sale, the difference between your sale price and fair market value becomes a capital gain again. So one thing would be is I would also recommend hold your ESOPs at least for a long-term time horizon. If it is an Indian equity or let's say a listed security, you can get the benefit of 12.5% taxation on your capital gain and make use of the 1.25 lakh of exemption. Align ESOPs with your life goals. Use your ESOP proceeds strategically. Down payment for a house, child's education, retirement planning, or let's say for example you have any other commitments, you can plan your ESOP for the same. So make your financial goals a trigger, not only the market movements. So bonus tip for most people that miss out is review your vesting and exit clauses regularly, especially if you're planning to leave the company. Be prepared for any liquidity events, IPOs, buybacks, or acquisitions. Plan ahead. Consider opportunity cost. Exercising ESOPs requires cash. Ensure you're not sacrificing your other priorities. And don't let loyalty override logic. Believing in your company is great, but blind faith can hurt your finances. So back to Rohan, what should he have done? Not panicked, held through the dip, planned a phased exit as the prices recovered, and diversify the same before a fall. That's what we want for you too. ESOPs can be a gateway to serious wealth if managed right. So keep your exposure in the right check, diversify the same, and make ESOP decisions that serve your life, not just your loyalty. Need further clarity on your ESOP holdings? Reach out to us on our official handles and get an expert advice on the same.